Hey guys, if you're looking to generate more income on your stock portfolio with options, I have a great strategy I've been using that I just wanted to share with everyone. I'm able to generate right around about 240,000 on average with a $1 million portfolio. It comes out to about 20 to 24% return on your portfolio. And you want to do this with a stock that you like and you believe is going to continue going up. So I'm not doing meme stocks. I'm doing large cap stocks, everything that's in the NASDAQ and S&P, top 25 companies. So if you're really looking to generate more income, you don't want to day trade, you have a decent sized portfolio, you want something so that you can set and forget, come back a month later, this is going to be a video for you. I'm going to show you my $1 million portfolio as well. So let's get right into it. Let me get rid of these marks. I'm just going to hop over to Thinkorswim with Schwab. So I'm going to refresh this so you guys know it's real. It's a legitimate account connected to real time, right? I'll add some other accounts here, but the account value here, $500,000. You guys can see all the buying power, etc., all that stuff. So you guys know it's legit, and I'm not making it up. Unlike some people online, they'll teach you strategies that make no sense and also things that they've actually never used. And then I'm going to hop over to Fidelity because this is where I like to trade this type of strategy, just because you can double dip, and I'll explain that. So as well here, 1.4 million in all accounts, but 500,000, another 500,000 here, and you guys can see the growth I've had, super steady, except for when the tariffs hit the middle of this year. I had a big drop, not a huge drop, like 25,000, but anyhow, I've gotten way past that and continue to grow about 28,000 ish the last few months each month. So let's go through it. As I said, if you don't care about day trading, this is a good strategy. You have a decent sized portfolio, you want to set and forget, and you're looking for higher returns than you would get normally with a high yield savings account. What we're going to be doing is something called selling cash secured puts. We're going to sell them on a monthly basis, so 30 days out, with what's called a 15 to 20 delta. So essentially, the chance of it going under your strike price is about 20%, 15 to 20%. And I'll explain that. And the ticker we're going to choose is Tesla. The reason I choose Tesla is because I like the company. I think it's got a great future. And you want to pick a company that you like. That's number one rule. You're not going to pick some company you do not believe in, because you need to have some belief in the market here. And you want a company that has some volatility. You don't want crazy volatility, but you want some volatility, because we want the options premium to be high. And that's what we're going to be doing, is we're going to be selling options premium on the put side. So the goal here, and we're just going to pretend we're doing this with $100,000 instead of $1 million, because we're not putting all of our eggs in one basket. So what the trade setup is going to be is selling 4 Tesla puts at 290 for about a month out, because today's September 1st. We'll go to the October 3rd timeline, and we want to avoid earnings. So they have earnings around October 20th. So we'll probably skip the next month and move on to a different ticker. But we're going to go to October 3rd. And I'm just going to hop over to my account on Fidelity so I can show you guys this trade. So we're going to type in Tesla here. We're going to go sell to open for puts for October 3rd. And we're going to go down to the 295. I think I did the 295. It was actually, I think, 290. There you go. The 290. And we're going to pick the midpoint for the sell price. And we can see we're going to have a gain. Essentially, we're going to get about $1,800 with a total risk of about 114,000. That means if the stock goes to zero, obviously Tesla's not going to zero tomorrow. So that's just the number. That's just the dollar amount that's going to be set aside if we were to get sold these shares at $290. So essentially, Tesla would have to drop all the way from $333 to $290 in the next 40 days or so. About 40 days left, or really 33 days left. That's likely not going to happen. If I go to Tesla's chart here, we can see it's just been hovering right here. It went 304 in July, went 302, right, 320, 333. The lowest it was 293, and then we had 285 in the middle of June. So it's unlikely that it's going to break down, and especially if it, all the news has come out. We know the credits for the Teslas are going away. Everything's been, kind of given out, and right now it's just been on an uptrend as well. So it's a great premium to sell. So once again, right, we're selling the cash secured put. So there's a requirement 290 because we're going to have to acquire 100 shares because we sold 4 contracts. It's about $116. So this is cash that's set aside for collateral. But the yield that we're getting for this, so we're going to get a return here. Let me move this up a little bit. We're getting a return of about $1,800. So it's about 1.5% for 1 month of hold. So annualized, that's about 18% return. Plus, Fidelity continues to give you interest on your cash that's in the account, even though this has been set aside, as long as the put is not assigned, and this is why I love, they continue to pay you out interest. So on that $116,000, we're also getting another $400 extra. So this is another 4.1% annualized. So if we start to add this up, we're actually getting an annualized return of about 22%. So it's a solid return, when you're looking at things. Do anything, you could just put this on, walk away, and move on, right? And our break-even price is $285. And if Tesla stays and goes below the expiration, we're going to take a loss on whatever the price is below that. But we don't mind getting Tesla at a discount at this point, right? We like Tesla, so we're gonna buy it and hold it for a discount, and we're gonna get assigned the 400 shares. So that's just, that's really optimal, especially if you want to get in the stock. You can get into it at a discount, or you can just continue earning 22 to 24% interest on your money. And there's a way to work around this if you end up getting assigned the shares, meaning that the stock went below 290, you're actually able to sell covered calls at that point. And you can sell the covered calls another month out for the same, strike price at 290, and you would get paid a healthy amount. So let's just go back and pretend that we ended up doing this a month ago and we sold it at 333, and now we have to sell the call at 330, let's just say 335. Well, we're going to end up getting paid about $2,000 per contract. So we're going to get $8,000 for this if we were holding the shares as well. So it's just a very lucrative way of trading options rather than buying, a weekly option, out of the money at, 355 and hoping and praying that your $100 turns into $1,000. That's all really gambling at the end of the day, right? Options are more of a hedge instrument for most people. Most hedge funds and institutional traders are using it as just positioning and helping, inverse some of the risk positions that they have and mitigate some of the risk that they have at times. So, it wasn't at the end of the day probably meant to be traded as it is by retail traders. So, instead, you want to somewhat become the bank at this point and start selling premium and collecting interest off that. So this is a great way of doing it. I've been doing it constantly for the last 2 years. This is better than, in my opinion, the yield max ETFs, which are deteriorating in, NAV value. So the price of the stock is going down, but you're getting paid out yield, which is not the best scenario. And when there's a large drawdown, those stocks continue to fall drastically and they never recover. So this is a great method that you can earn interest on your money. The only downside here is you got to have a little bit of a sizable portfolio. Now you can sell 1 instead of 4, but this works well when you have a larger portfolio, because 10, 20, 15, percent, etc., 25%, all that adds up, especially when you have a $100,000 portfolio or $1 million portfolio. That definitely helps out quite a bit. So obviously not being unrealistic about it, but having a larger portfolio helps out quite a bit. If you guys have questions, comments, leave a comment below. I'll be able to help answer some of those questions. And like the video, subscribe. I'll be making more videos on different option strategies that I'm utilizing to help grow my portfolios to well over, it's going to be $2 million, not $1 million at this point, but continue growing my portfolios and scaling them up. Thanks, everyone.